Jobs number, of course, today, 29 straight months of strong growth, ahead of consensus for 14 straight months. Joining us at Post 9 this morning, Goldman Sachs chief economist, head of global research, Jan Hatzius. Great to have you back, Jan.
Wonderful to be here.
Here we are again, sort of trying to decide survey, household establishment. Is there confusion this month or not? Is the direction pretty clear?
It's a bit noisier than normal, I would say, because you had a lot of strength in the establishment survey and a big drop in household employment and also some weakness in the work week. But if you cut through the noise, I would say it's a strong report. It shows that the labor market continues to make progress. It suggests that we're still getting the benefit of increases in the labor force, and it shows that the economy is currently at least nowhere close to recession.
Does that mean you're able to look past the jump in the unemployment rate?
I think you can, because the jump in the unemployment rate was really driven by a decline in self-employment. And I do think that this can be quite noisy. If you look at the household survey adjusted to the definitions of the establishment survey, you actually got a healthy increase in household employment. So overall, I would say it's a strong report and confirms that the labor market remains very solid.
Once upon a time, maybe 6 months ago, I don't know, it was believed by the markets that the unemployment rate would have to worsen, that people would have to lose their jobs in order for the Fed to take a pause and declare victory on inflation. But we have seen inflation roll over in many key areas: energy, metals, food, all of that's really rolled over. Do you think that we could have a scenario where the Fed actually pauses for good? I'm not saying that's going to happen at the next meeting, and the jobs market is allowed to remain relatively strong? Yes,
that has been our view, that you can rebalance the job market in one of two ways. One, through a big increase or sizable increase in the unemployment rate. The other one, the much more benign way of rebalancing the labor market, is to bring down job openings. And yes, they're still trending down despite the latest increase. Declines in quits, declines in labor shortages, and a more gradual rebalancing, which is, I think, what we've seen. And if you look at the wage numbers, you're also seeing deceleration in addition to some of the more encouraging aspects of the inflation news that you mentioned. So I think that does set us up for a pause. We are expecting a pause in June. In fact, we have a stable funds rate in our forecast through the remainder of the year. Obviously, there are risks around that. I think the risk at the July meeting is towards a hike. It's possible, but our best guess would be that this is it.